so much also depends on the pace of reopening, the consistency of the reopening from now to, say, perhaps this time next year, when we actually expect to see the economy and borders fully reopen at some point next year. Is this going to be a straight arrow when it comes to the markets?
It probably won't, Heidi, but the general trend is up. I think that's undeniable with the Hong Kong index. And to your point, it is not a consistent opening. It is not a coordinated opening. But so far, they haven't backed down. And today, apparently, they might announce 10 new measures to complement the 20 measures they announced in November, the easing measures. So I think they're serious. I don't think they're going to stop. And the Hang Seng Index did get as low as 0.65 times book, which I think we'll never see again in our lives. And now it's back at 0.8. But I don't think it should be below 1. Because prior to 2019, and this is an index you can go back to the 1960s, it never got below 1. So in between 0.8 and 1 is another 20%, and I think that's where it's going.
We continue to look at the data points, right? We're getting trade today. We're expecting to see both exports and imports seeing weakness from demand-side issues. The economic fundamentals of China, even if we get past COVID-0, are challenging at best. So where do you see, I guess, the opportunities that can withstand the amount of resilience is going to be required to get through some of these other challenges, from the property sector to just the demographics that we're looking at?
Well, all of those are very valid points. And so I'm not making the case for a structural growth story. I'm making a case for a value story. As I said, below 1 times for assets of the quality that the members of the Hang Seng Index have is too low. And, you know, there's a lot of stocks in Hong Kong where the price-earnings ratio is numerically lower than the dividend yield. Like basically all of the banks and the telcos and the energy companies, that you're looking at PEs of, let's say, between, 5 to 10 times, but then dividends of 10 to 15%. And I just remember Peter Lynch used to say that if you could ever find a company whose price-earnings ratio was lower than its dividend yield, you should buy it, because it shouldn't be that way.
Mark, and yet you're not bullish on commodities, despite the fact that you're bullish on perhaps China. So why the discrepancy there?
Well, Shery, once again, because the China call is a value call. It's not predicated on the economy getting a lot better. It's just predicated on the fact that, yes, they've decided to open up, and this is an incredibly deep discount. Yes, commodities, it's simply we see a lot of supply of commodities around the world. It's not so much that we think the economy is going into a recession. As a matter of fact, our models suggest only a 35% chance of a recession in the United States next year. But we're also only looking for 0.5% GDP growth in the United States next year. And so if you combine that relatively, well, there's not going to be tons of demand, let's put it that way, with GDP growth like that. And at the same time, what we see is quite a vigorous supply response in the energy commodities in particular. Then that's why we don't feel very excited about them.
Mark, we have heard plenty of gloomy economic outlooks when it comes to the U.S. From banking CEOs today. What are your expectations of how Asia will perform relative to the U.S. economy and the opportunities that perhaps that represents?
Well, I think this could be a year of outperformance for Asia, 2023, excuse me. Because the dollar is clearly broken down, and we see that as continuing. We think the European Central Bank is going to raise rates more than the Fed next year. And we think the backdrop for the European economy will be more conducive, quite a bit more conducive, in part because of the lower energy prices that I just mentioned. And so 2/3 of the dollar index is the euro, and if the dollar goes down, that's traditionally been a good thing for Asian markets, which are, with a couple of exceptions like India, very cheap. And so, yes, as long as the U.S. doesn't go into some terrible recession, even if it just has a mild recession, I think that's enough for the S&P to kind of go sideways, and then people to look for greener pastures elsewhere, including here in our region.
To that point, when it comes to recession risk, I want to get your views on our question of the day, which is which assets do you think are actually underpricing the risk, even a mild risk or a risk of a mild recession, I should say, because you can see that pricing perhaps in the inverted treasuries curve. You can see it a bit in, of course, the 7% decline from the cyclical peak for the US dollar. Is there more vulnerability when it comes to risk assets like stocks, though?
Well, the S&P's down 17% so far this year, and the Nasdaq's down 30%. So I don't think stocks have mispriced what's going on. I think those reflect a mild recession, which, by the way, I don't think we're going to get. But down 30% for the Nasdaq, in my mind, reflects a mild recession. So we priced it in already. And bonds have fallen relative to their history by an even greater magnitude, of course. So I don't think there's a lot out there that's really very mispriced. I think the market's been fairly efficient. And in fact, I see more things that are undervalued than overvalued right now.